I think there's so much change going on in the world right now. So you can list them. It's gene sequencing and health innovation. It's changes to the financial system. It's rebuilding infrastructure. There's all sorts of things going on faster probably than ever before, aided by artificial intelligence. I think it's curious how that's happening at the same time as there seems to be a sense of pessimism. Growth is not really something that people want to pay up for. I've never seen such a big gap between the opportunities that companies have on a 10-year time frame and investors' willingness to look on those sorts of horizons. So of course, I think that's an opportunity. Yeah, so I think it's important. AI itself is quite hard to invest in. So we try to look for companies which, the small number of companies that we can see really benefiting from that. So that might be the less obvious. It's things like diagnostics and healthcare. It's things like agriculture where we can have precision sprayers using AI. But then there are these much wider sets of opportunities. So the areas we're looking at are, if you think about demographics in the world, you've got an aging population. Healthcare systems are too expensive. We're going to have to find ways to take costs out of that system. How do we go about doing that? Then there's the financial system where banks make lots of money from foreign exchange, which is not complicated. That's all moving to apps and digital banks. It's these sorts of areas. Infrastructure rebuild. Bridges are falling down in the West. Airports are crumbling. So there's a big opportunity there, I think, to invest in some of the more, it's not all about future-looking technology. It's about copper and aggregates and the sort of materials we're going to need to facilitate things like the energy transition. We're probably soon to be in a falling interest rate environment. I think for us, we're interested in growth assets. I think that will likely be helpful simply because valuations on growth assets tend to come down when there's a higher discount rate. But actually, I think the key is to not be reliant on making a big macro bet on interest rates. That's not the sort of thing that we're trying to forecast. What we're trying to do is find companies that can be successful regardless of what interest rates do. And that tends to be ones that are doing something useful for their customers, that have the ability to grow because they still have pricing power. So actually, I think the best way to invest through any interest rate cycle is to try and look beyond that and find the small number of companies that can thrive in pretty much any interest rate environment. And that's a traditional approach to investing, which everyone seems to have forgotten in the artificially low rates of the last 15 years. I think we've been through a 10-year period in which companies could scale very rapidly with relatively little incremental capital. This is the digital world combined with cheap money has made it very easy for some companies to grow very quickly and globally. That's harder now. We're seeing some deglobalization. We're seeing the opportunities of the next 10 years will be in harder assets like energy assets, creating new drugs that's still very expensive to go through a testing regime. More capital is required for these types of companies. I think it will take longer for them to pay back. More capital will be required. I think what that means for investors is, frankly, just more patience than most people have shown in the last 10 or 15 years, and more physical assets, construction of factories, hard investment in a way that I think that will be significantly different than we've seen in the last 10 years.